Hey guys, Freaky Finance here. Last week we talked about Comstock resources and the play with the Texas winter storm Uri, and today we're going to go back to another REIT. I haven't done another REIT video for a while. The other ones have done quite well since the time of filming, but that's the nature of REITs. We knew they were getting hammered unfairly during COVID. Anyway, this is a different idea. It's higher risk than most REITs I've done, and this one is GEO Group REIT. There's a lot going on, so I got a lot of things to show in fairly quick succession. But basically, GEO REIT has for-profit prisons, is the way to say it. And most of the facilities are for-profit prisons. And you can see that predominantly around the Sun Belt. They got quite a bit in Pennsylvania. But yeah, and we'll jump into it right away. So here, basically the business model is that they have your owned and leased revenue. Then they also have their managed revenue. So managed revenue is obviously this contract out GEO Group to manage the facility, whereas the other ones that actually own or lease the facility themselves. So, and you can see that here up top with the REIT owned and REIT managed. Like I said, quite a lot of the facilities are secure services, and quite a few are reentry services as well. Not a lot of people know that, right? They just think secure services, for-profit prisons, but there's also more going on. Like they got youth services as well. And generally, GEO Group and for-profit prisons in general have been flagged as the enemy, especially over the last 5 years, I'd say. It's more targeted. The thinking there, general consensus is that for-profit prisons make money off keeping people in prison instead of getting them back out of prison, right? Another way to look at the geographic footprint is really through the number of beds in each state, which state is most important for revenue. And you can see predominantly quite a lot in Texas, California, Pennsylvania, as I mentioned, quite a bit in Colorado as well. Florida has a low number of facilities, but a high number of beds. So they got some pretty big facilities in Florida. And generally speaking, the bigger the facility, the bigger the scale for the company's profitability. That's kind of how I view it. But overall, you can see quite a lot in the southern United States. And they do have some managed facilities that actually bring in a decent amount of money in Australia. But again, relative to the beds in the United States, it's small. And just to give you an example, so this is a processing center, Aurora Ice Processing Center, and it just kind of gives you an idea of what they kind of look like. So ICE is basically for U.S. Immigration and Customs Enforcement. We're going to go through these really quick. And most of these facilities are actually, well, I mean, I haven't actually had to be in one, so it's hard for me to say. But on the outside, they look fairly good. They don't look like your typical prison would in my mind. Some of these, I'll show you this one. I just clicked on a couple at random, but you can see this one has like a soccer field. And again, mainly this is a different use, right? This is for immigration. So these people that are just trying to immigrate to America, I mean, they're just checking to make sure they're not criminals and stuff like that as they go through the process to either decide whether they want to be accepted in the United States or deported, right? So that's kind of how I view ICE facilities. They're slightly different than strictly your prisons and your jails that you're thinking about in movies and stuff like that. So this is probably the most important slide on their current slide deck, and it breaks up, one, it has the occupancy, and two, it has the revenue by customer type. So there is customer risk here, and that's one of the reasons why the stock has been hammered. And one of the reasons why I'm looking at it is US ICE represents 22% of revenue as of fiscal year 2020, or the BOP, so the Bureau of Prisons, 13%, the Marshals, 11.5%, and then you have all these states, so the state level as well, whereas these FOB and the Marshals are under the Department of Justice, and then you have the Customs through ICE, immigration. And you can see the pie chart right here breaks it up really well. And right now the issue is orange, the BOP. Basically, we'll get into more of the details, but basically contracts are not being renewed for this 14% of the pie, and we're not sure on this 13% of the pie up here from Marshal Services. And then you also have to worry about ICE, which could be under pressure as well. And I think the market's trying to price in what's true and what's not, and that makes this, going into this, very exciting for me. Set, right? It was dipping before, but not to this level, right? In the 85s for a bit there. And we've noticed an uptrend lately, and my thinking is we're going to see an uptrend again. And I'll talk into why in a bit. Okay, let's jump right to the numbers first, just to see what's going on and why I'm looking at it. You can see 2020 with COVID wasn't great. Revenues were down 5%. A lot of that was due to COVID and that occupancy chart that I showed where it went from like, say, 93s to 85%, right? And that's more of a function of less immigration due to COVID, like all the borders closed, right? And that's the same with anywhere in the world. Operating expenses, so it went down in line, which is always good to see. It's always good not to see stickiness in COGS, right? Because that means it's actually COGS. GMD did go down 46 million. so not great, but not the end of the world. Depreciation continues to go up, and the weakness here is G&A continues to go up, whereas revenue went down. So they decided not to cut anything, even though they had technically less people using the facilities. They had some impairment, 21 million. However, they reduced their interest expense by 15% year over year. Income tax were higher. But overall, you can see, really, if I take the 50 million less in GMD and I add back the 20 from impairment, I get that 70 delta. So not great, but you can see the reason why I'm looking at it, because there's quite a lot of red here, is the share price. So it's gone from over 20 bucks. These are at year end. So December 31st, 2018, pretty much 20 bucks. Continues to decrease, 16 bucks, and now you're getting it at 8 bucks. So about 60% cheaper, or $1.4 billion cheaper. On the balance sheet side, it has degraded with the decreasing in operations. And one of the things with REITs is that they have to pay a large percent, about 90% of their net income in dividends. So what happens is that retained earnings can't build. So their total equity, even though they're profitable, it doesn't show that because they're paying so much in dividends. So what happens here is that it looks bad, right? You have 2.9 billion in real debt, and you only have 900,000 in equity, right? So when you're doing like a debt to equity or anything like that for REITs, you gotta keep that in mind. So there is a lot of debt. They do have a lot of tangible assets though, but they also have intangible assets, which so far have been starting to get written down with lower occupancy. We'll have to see how this number shows up with the latest announcement from President Biden, with basically Department of Justice not being able to renew contracts. CFO is slightly misleading. I mean, if I add it up, I'm getting around like 280. So there's a big swing there in working capital adjustments, and 280 is in line with the GMD shortfall of around 50 million. But overall, still quite a bit of cash flow. They did start slashing their dividends paid, which I view as prudent. But you're still getting, even right now, even though they've slashed it, you're still getting around 12.5%. But this thing's always been a high dividend payer. Right now it's paying about a quarter. So $1 a year. $1 a year on $8 share price is quite a high dividend yield. Keep that in mind. It's yielding a high dividend, but that shouldn't send your greed flag flying. That should be your fear flag, because there's a reason why it's that high, is because the share price is getting slammed. So GM actually increased, or stayed steady rather. However, G&A, like I said, decreased, profitability decreased, but the PE continued to weaken, right? So the market's starting to be like, okay, this is a trend, and it's starting to discount that in the future and say, okay, you're going to continue to shrink, so we're going to give you a fairly low PE in this day and age, right? And today's date is March 13th, 2021. Earnings per share, 85 for the year. So again, you're at 85 cents and your share price is less than 8, so you're less than 10 times earnings. I think my thinking here is that it's kind of like a crossroads where the market's kind of front running a decline, and the current fundamentals are still kind of lagging that. So like they are going down, but they're not going down as fast as the share price has. And one could argue it's front running a very dramatic decline over time, and the market generally over exaggerates things. So that's kind of where I jump in, because this thing screens very well, right? You get like a PE under 10, and you're like 60% from the 52-week high. So it looks good from my point of view to look at it. So that's why I'm looking at it today. And I did punch the button on this one. I do own this one. I just put a smaller position in. And what I might do is I dig deeper, is either add if it comes against me again. I literally got filled on this order, and then I think like the next day it went like 10% against me. So, but now it's kind of edged its way back up. So let's go back to the slides. So this one, I just want to bring up the capex real quick. You can see out of their capex, it's actually not that bad for a REIT, and most of it's going into growth, which I thought was interesting, instead of maintenance and facility improvements. So I'm surprised the government didn't just try to force these for-profit prisons to put more into maintenance and facility improvements, right? If that's the issue, regulate these guys to increase the maintenance of facilities instead of altogether cutting them from the pie, right? It's very weird. So you can see the decline year over year. And share count, I didn't bring it up, but it's slowly been increasing. So again, not great. And I didn't bring it up on the financials, though I had it written down, is that they have been still paying themselves quite a bit, right? I went from 12 million in share-based comp to 19 to 22, 22, 23. You gotta remember, in this time period, their share price went from 20 to 8, and they're still getting paid quite a bit. So I don't like that. I rather see, like, they are trying to be aligned, that's what this is. But when you're still making the same and all your shareholders lost, 70% of their value, like, yeah, I don't know. So anyway, another reason I don't know if you guys saw when I did MSG Networks. Same thing here. Michael Burry owns this one, 3% of his portfolio. He actually owns the other correctional facility as well. Not a huge amount or anything like that, but 3% of the portfolio. So it's kind of interesting. Here's the order from the White House website. And you can see January 26th, right down here, section 2. He says the Attorney General shall not renew Department of Justice contracts with privately operated criminal detention facilities. For reference, Department of Justice. We go through their org chart up here. And you can see the Bureau of Prisons and the U.S. Marshal Service are both right here. Importantly, I don't see ICE here, but those two are there. And we know as of 2020, they were 14 and 13% of revenue. So 27% of revenue has just been told by the President of the United States not renew Department of Justice contracts with privately operated criminal detention facilities. And that was more like the market was already front running this. Like I'll talk about the share price in a second, but you can see when the odds of Biden being elected started increasing, it was selling off pretty hard, but it's been selling off the whole time, right? In 2020 with COVID, didn't help them at all, right? You saw this spike down as well. We'll go back to the chart later, but you can see this thing has just been destroyed over time. So on the conference call, they do talk about the Marshal Service, because that's what I was trying to see. Because right now we're getting confirmation that the BOP, the Bureau of Prisons, is actually canceling or not renewing their contracts as they come due for renewal. So far, not sure on the Marshal side yet, but the market's probably trying to price that in, right? On the COVID side, and this is important because I don't think that many people realize that COVID does have an impact on this business. And the CEO's words, he views it as 15 to 20% in profitability for 2020 was from COVID. So this predates the Biden decision, right, to not allow DOJ to renew contracts. And 15 to 20% is no small feat, right? Relative, so there's currently 3 facilities that are currently not being renewed. And altogether, they're about 35 million each. Times that by 3, you get 105 million. So 105 million less in sales in 2021 as they roll or are up for renewal during the year. So again, not great. So we look at the numbers, and so you're down another 105 million, right? Now, one of the things that's interesting is that you're going to start getting vaccines, and we're already starting to see immigration increase. So you might start seeing an offsetting in ICE, and I don't think the market fully appreciates that. Or maybe the market's just saying we don't know if what ICE is going to do. So they're actually fearful of that, so they're actually discounting even more. Because ICE was a huge part of their revenue as well, right? And then this analyst asks, like, hey, so those 3 are expiring in 2021, so we know you're going to be 100 million poor. What about 2022, right? And this guy says, okay, there's another BOP. It's another about $35 million, so they're going to be down another $35 million in 2022. And then they're going to be down another 5 to 7 in 2022 as well, so about 42 million. Not a great trend when you're thinking about it, right? But you got to remember the market's already trying to discount this. And that's one of the reasons why it's so cheap and why it screens so well. So it's a very interesting time to look at this company. Normally with REITs, I do the AFFO and AFFO, so that's just here. I didn't put it on my little spreadsheet, but you can see the FFO is down about, well, actually it's very much in line with what I said, about 50 million in GMD less. That kind of shows the delta in FFO anyway, assuming all else constant. And dividends per share have already started getting slammed. Right now you're at 25 cents a quarter. Before it was paying about $2 a year. Continued decrease in dividend, which I view as required because the profitability is go down. One of the reasons why I'm looking at it is because, okay, we got all this negativity, right? You got the public that hates for-profit prisons, and then you have kind of like just the polarization. I don't want to really get into politics, but you have the polarization of policies, right? You have Trump, which is very against immigration, and then you have Biden, who's very much for immigration, right? And so if you're someone on the south of the border of Mexico, you're thinking, okay, so there was a real strong red light before, and now you have a fairly decent green light, right? So that rate of change in policy is very stark, and we're seeing that now on the border, right? And the messages from the White House have kind of been mixed because they're not really sure how to deal with this because their ideologies say everyone should come to America, right? That wants to. So and then you have the people that are actually dealing with the mass influx of people. And we saw that similarly when Germany, right, when there was a lot of refugees coming in, Germany had to make a decision. And they were never popular decisions. And so far, the American government with the Biden administration has done popular decisions more so than maybe what's pragmatic, but that's just my opinion. So here you can see the effect. So you have about 90,000 people crossing the border during last year. And as of, I want to say, 10 weeks into the year, at 52 weeks, you're already past that number by 10%. So big increase. And part of that is also you're going to have these low benchmarks from COVID because borders are really closed, right? So you're going to have these huge deltas. This chart from the border protection is very interesting. So you can see Southwest fiscal years. 2019 actually pretty good. And interesting enough, that was also the high for GEO Group REIT, right? So very interesting timing here. And right now we're getting a peak again in 2021. And relative to 2020, it's stark because one, you have the border more open than it's ever been probably 4 years. And then you have the year-over-year effect just because COVID was so low. So you have this very stark contrast, and I think this is going to start showing up into ICE's numbers, and they're going to need a place to put all these people to process, whether they want to keep them in America or deport them back to Mexico or wherever they're from, right? So you have this stark contrast. I don't think the market is appreciating the power that ICE has on the performance of this company. Or maybe the market's saying, well, we don't know what ICE is doing. We don't know if they're going to renew contracts either. Or maybe the government's just going to start making their own facilities to put GEO Group REIT out of business, right? Who knows? Or maybe they just buy Group REIT out and make them all federal employees. I don't know. I really don't know what they're trying to do here. But right now, that order pretty much looks to me like they're declaring war on for-profit prisons, which is probably what they want for their political agenda, right? Because that's the popular thing. So what we're currently seeing, aside from more people, is that you're seeing some side effects of that. So you have 25 people in an SUV during COVID still, 13 dead. So that was March 2nd. So all these are very recent. It doesn't take long if you just look at immigration, America, March. You're going to get a whole lot. Anyway, this is more lately. So unfortunately, one of the things they ran on, or the Democrat Party ran on, was kind of like they're like, you guys put people in cages, right? That sort of, I don't know, political stuff. But what's happening is literally when there's enough people coming in, you got to put them somewhere, right? And that's to process them. So that's what's happening now, and now they're in overflow again. So you can see the kids in cages is being used again as of Friday. So things are already in overflow down there. There's a lot of immigration coming in. This is just the ICE on the ice.gov website, and you can see that quite a few of the facilities are run or owned by GEO Group REIT, right? So there's a huge correlation here between the performance of ICE and the performance of GEO Group REIT. Other ways to view like the higher demand for immigration is that the cartel will use the influx of people, right? People that really just want either them or their kids to have a better life, or that's what they believe, have a better life in America than they would in Mexico or wherever they're from, south of the border. But the cartel will use them, right? Just because they know the systems just had a big polarizing shock, right? You had very stark anti-immigration, and now you have this kind of, well, we won't enforce it, maybe we will, immigration kind of, and it's not even that, it's just because of that thinking, people are just going through the border, right? They're just trying to get through because there's this buildup, kind of like a bottleneck over the last 4 years. And so you have this kind of side effect as well, where you have all the drugs that the cartel is trying to put through because they know the system is overwhelmed. And you can see here is just another metric. So 64% year over year. Here's another one. These are like March 11th, March 13th. So very recent. And you can see their first 5 months, they're already over the whole year last year for fentanyl. So yeah, no, drugs are coming in, or the cartel's using the people as a shield to overtax the system to bring drugs in. That's how, if I was a cartel, that's what I would do. So one of the other cons of this company, so right now you have the con of the BOP, no more renewals. You have the likely con of Marshalls, we're not sure. Then you have a risk of ICE, which we don't know anything about. And then you have the fact that the government's making it hard to lend money to these guys now, right? Because there's literally this popular opinion against for-profit prisons. And we know E and the ESG is very important, right? And social and governance as well. But you can see what this is starting to do to this company is that these rates are okay, right? Here, 5 to 6% basically. And then we look at what they had to issue just on February 25th, so 2 weeks ago. And you can see that they're issuing 6.5 with sweeteners as well. And they're just doing that to pay off their 5 and 8. So unlike other companies which have been able to refinance much cheaper, especially during COVID because rates are so low, this company is forced to actually increase their WACC, right? Or at the same time, everyone else is able to get cheap financing. And now they're starting to compete with the government who can get the cheapest financing possible because they just print money. So this investment is it's so convoluted. And it's kind of exciting to see how this is going to play out over time, right? So I just put a little bit of money in it now just to see, and then I'll make, as more information comes clear, I'll probably make more of a decision. But the value and the dividend yield alone is fairly attractive, right? So I've been burned by that before in the past. Yeah, and this is just a reference to their dividend cut. This is their guidance, which I thought was interesting. So we know that they're going to be about 1 million less, 105 roughly, from the 3 BOP contracts that are up for renewal throughout the year. And I should say they're not just, when they're up for renewal, they don't just sit there. Like, they are going to try to sell these facilities to states, right? Your state of Florida, instead of just the borough of prisons. So that's kind of what they're going to try to do to hedge it. We'll see if that works. But anyway, their guidance summary, basically 2.2 million. Let's say 2.25. When we go to what they did last year, they're basically just saying, yeah, we're going to make about 100 million less, which is in line with the BOP delta decrease. However, they also guided still around the same bottom line, so 0.88. So if you're buying in at 8, you're basically still buying in at less than 10 times 2021 earnings, according to their guidance. Capex remains low. I'm surprised they're still putting quite a bit into growth, given they're growing into a place that doesn't seem to want them. If I was the federal government, I probably would have just allowed them, but forced them to put more money in maintenance and facility improvements. That's probably how I would have dealt with it. So anyway, the chart looks terrible, which is why I'm excited, and that's why I got in, right? I'm pretty sure I bought in on like one of these days after earnings, and then it got smacked because of that raise where it had to get financing at a higher rate than what it's currently had to do. So and then monthly, if I go even farther time horizon, right, it's not great. In 2017 was the peak for profitability. This thing was at $30, right? Actually highs of 32. So you're down 32 to 8, right? You're down 75% if you held for that from peak to trough. And the company is much bigger and stronger than it was back in 2012. So obviously the market is pricing in more difficulty for the company. 2021 doesn't look great, like they're guiding down basically the delta in BOP contracts. But yeah, it's super interesting. It'll be interesting to see the effect of no BOP contracts being renewed versus higher immigration coming in, because Biden is so pro-immigration. So on one hand, he's almost like his policies are penalizing the correctional facility side, but rewarding the immigration side. And these two things are going to keep meshing with each other, and the market's not sure how to deal with it. Right now it's priced like a loser and a continued loser. So if it continues to lose, then it sucks buying in right now. But if this is starting to net out and maybe turn around, it's an exciting time to buy this company, right? Because you're getting paid 12.5% right now, right? You're getting paid $1 a year in dividends on an $8 stock. So yeah, I'd like to know your thoughts on GEO Group REIT. It's a dicier REIT for what we've talked about in the past, but it has a lot going on, and I can see why someone like Scion Capital, Michael Burry, is invested in it. But yeah, have a great rest of your weekend.